And we are live on with this special broadcast with Jeremey Iannuzzelli from KHI Partners. So we wanted to bring this to you because of the recent sort of Queensland land tax situation. So wanted to make sure. So how you going today, anyway, Jeremy? Let's see. You going well?
Yeah, well, buddy. Yeah, well, like everybody else, a bit shocked at recent legislation in place, but yeah, no, well,
Yeah,
tax season,
legislation in place. That's what I'm interested in. It's just gone through. It's happened. It's done. There's not too much we can do about it from a government perspective. We just have to find out ways to optimize and run it. But this is why we wanted to get you on, Jazz. This is not many people know how it actually works or what it actually means for them as investors. So I really appreciate you taking the time to run us through this, so people can get educated and make sure that they make the right steps on building out their portfolios. I'm excited. So what exactly is this, right? Because I've been seeing in the group, people are saying land tax for Queensland. What exactly is it? Like high level, how do we understand?
So land tax is a state-based tax. All various states have their own different ways of calculating land tax. It's a fake tax. It's a revenue generating tax with no purpose behind it. Essentially, it's just to fill up the state revenue coffers. Simply like stamp duty as well. What's stamp duty? It's just a transfer tax. But it's a way for state governments to collect extra revenue and spend it the way they wish. But this interstate property land tax legislation comes in from 30 June 2023. And essentially speaking, what Queensland state government is saying is that when we calculate the land tax, we're now going to use the total value of your Australian land. And this also includes the taxable land in Queensland and your relevant interstate land. So they're essentially saying, we're going to look at your whole property portfolio. We're going to look at the land value of that whole property portfolio in all the states that you have. And it's going to diminish, obviously, your land tax threshold here in Queensland. And we're going to tax it and reduce the threshold based upon the proratement of your Queensland land value. So I'll show you how I think their calculation, unfortunately, is not fair, because we've done some numbers and, we've shown where someone could potentially pay $20,000 land tax on a $380,000 land value in Queensland simply because they've got about $4.9 million worth of property, including their land in Queensland across Australia. So I don't think this one's fair. I don't think this is, I think, tangible in many people's eyes. I think it will impact some people's decisions, but it also gives people an opportunity, once they understand it, well, what ways they can implement to minimize the damage of this interstate land tax.
Yeah.
So you've been actually having...
I was going to say, before we get into it, people have questions or comments, because it's going to be, everybody's got, this is on the tip of everybody's tongue at the moment. So if you have questions or comments, drop it in and we'll do our best. Jeremy, we can't guarantee you'll answer them. But yeah, this is an opportunity for people to ask those questions, and we love comments as well. But stay tuned to the end because we will have an opportunity to see how you can potentially combat it as well. So over to Joe.
Yeah, well, one of the things, Jeremy, I want to understand is, how did you get educated on this? Like, you were talking about having a large number of meetings with a lot of people to be able to distill this information. Can you give us a bit of an insight on that?
So initially, land tax was something that I educated myself many years ago when I was, I am investing in interstate areas. But I've obviously connected myself with a lot of people around Australia in various different states, various professionals in those states. And I was speaking to a couple really good solicitors I know, property solicitors, and just getting their take on it from a professional legal point of view to understand the definitions and what's it all mean. But that's what I've been doing. I've been having this week and spending a lot of time with some experts in this space, especially experts in the Queensland space, and identifying, well, what things to pick up, what are they actually looking at, is it legal? And they've all said that it is, but it's very hard for them to obtain all the information from the various state governments. So that's why that they're making people do a self-declaration. And then obviously, what are the things that they're going to be looking at to pick up those people who don't do a self-declaration? So that's been my week this week. It's speaking to some professionals who do this day in, day out from a legal perspective, and just ensuring that I capture the definitions correctly.
As well as lodging tax returns as well. The end of financial year.
Yes.
Busy boy.
Is this a double tax then? So are people paying double the amount of tax?
Yeah, so you're only getting charged tax on the proratement of your Queensland land value. So I just want to make that very clear. The problem is that the taxable thresholds or rate of tax for land tax is done at various different rates for various amounts of property that you own Australia-wide. So it's not a double tax as some people are saying. Because you might be paying land tax in Queensland, but not essentially paying land tax in New South Wales on a couple of examples that I'll show you. But it is robbery because essentially you are paying land tax in Queensland at some potentially a much higher rate than what you would have if you just had that land in Queensland under the old scheme. So it's not a double tax as per se by definition, but it definitely feels like it.
That's interesting you use that word robbery because I know you're one who's very level-headed and calm. Well, not necessarily, yeah. So you're someone. So for you to use that word, I think that sort of speaks to the volume of the impacts these changes.
Correct. This is a penalty, Jeff and Joe, and I'll explain it in detail and I'll make it very clear. And I'm happy to accept criticism on behalf of anyone who wants to share it with me or tell me off. The Queensland state government is in a substantial amount of debt. Probably by far the worst state in all of the country. And they've got a lot of bills to pay. They've got a big public sector. They've got Olympic Games to pay for. It's a very big state that spends a lot of money and has spent a lot of money under a Palaszczuk government. And this is a way now of affecting the people who will not affect the votes. So I will say that sentence again. It will affect the people that do not affect the vote. So it's going to affect the people in New South Wales and Melbourne and WA who chose Queensland as a state to invest in because of potential higher returns and capital growth, and also to obtain and receive a new land tax threshold. And we're not necessarily voters in Queensland. I don't vote for a Queensland state government, but my land tax dollars are going to go towards substantially fixing their problem, which has been spending a lot of money for a very long time and making poor decisions.
So that's the why. That's why this thing is here, because they need to bump up their balance sheet a little bit. Is that what you're saying?
They need to fix their P&L. And they've been running at a deficit for quite a while. And the only way to fix a deficit is to cut costs, which will lose an election.
Increase expense, increase income.
Increase income is the better way to do it. And even better is to increase income from people who don't necessarily vote for you.
So everyone in New South Wales, WA, Victoria, South Australia are the ones paying for this. But the people in Queensland are loving it because they're like, oh, well, here's some more money coming in. Happy days. And then they're not affecting the people in Queensland.
And look, it may affect Queensland investors, that's for sure. Because if you've got a Queensland investor who's invested in Tasmania or Victoria or New South Wales, it will impact them. But remember, a large portion of investors generally invest in their own backyard and in their own state.
Well, with our group, Oz Property Investors, we have interstate investors. This is what we say to everyone. You need to go where the opportunity is and not necessarily being in the state that you're living in. So a lot of the people in this group have built portfolios with Queensland, New South Wales, Victoria, Western Australia, Adelaide. There's a whole heap that are interstate. So do you see other states starting to implement something like this?
I never want to put fear in other people's minds because it's a question which we don't know. But, if it works, and I think it's going to work, definitely in the coffers from a Queensland state government point of view. But if it works without too much impact on the rental market, I can't see why not. It's kind of like banks when they lift interest rates. They're all waiting for that first bank to lift the interest rate and then the rest will follow. The herd will come. So there is potential. There's no doubt about it for other states to do it. But there are repercussions that come from it. It takes away, obviously, investment into a state potentially. But the other side is a lot of investors who will get to understand this legislation a little bit further may be out of pocket and they're going to pass that cost on to their tenants. So rent's probably potentially going to increase in Queensland to help offset this additional cost that we didn't know about. And without knowing it, they might be hurting their own residents from trying to make something more equitable or profitable for the Queensland state government.
But that's a hard line to draw, isn't it? You know, in the media, it's a little bit tough to be able to say this is all connecting in.
Yeah, and the problem is they've made it so soon. So from 30 June 2023, you're going to need to complete this declaration or earlier, within 30 days of receiving the land tax notice, or you have to apply for it and register by the 31st of October. So this is brought on pretty quickly. And there's a lot of people out there saying, well, Jeremy, I'm not going to declare my properties in New South Wales and WA and Northern Territory and Melbourne. I'm not going to declare it. They can come and chase me. And look, that's a question I raised to a couple of these professionals. And what will happen is, number one, it's very profitable for the Queensland State Government to create a task force and a team to check every single investor. Very profitable. Yeah. Secondly, they're going to be looking at implementing a land tax clearance certificate. So, for instance, anyone who sold property in New South Wales, your solicitor, first thing they'll do is, or bought property in New South Wales, the first thing they'll do is order a land tax clearance certificate to ensure there's no land tax that's been bought or sold with the property. So they may implement professionals such as accountants and solicitors to sign off on that land tax clearance certificate, making the professionals unfortunately liable for any mistakes that are made. So they're covering their bases. They're not going to implement this particular tax and say that, oh, it's voluntary, you do it if you want to, donate extra money to us. This is very profitable enterprise for Queensland, and they're going to make sure that they're going to capture you. And it may be 1 or 2 years, it may be 4 or 5 years, it may be 10 years, but sooner along the line, they will catch you, whether it's sold or potentially on their own accord, and there will be penalties and fines. The one thing that I have spoken to with the Queensland State Revenue Tax Office is they said, we will be catching people and there will be penalties and interest imposed for that late payment. So this could be
a scary phone call to have.
Yeah, could be very expensive exercise. And what people don't know, for instance, our tax returns are a self-declaration we make. You know, we don't submit the receipts in with the tax office when we do your tax return. As a tax agent, we work for the ATO. They utilize us to help people do their tax returns the right way. It's only until the tax office review is when they generally catch a lot of people out. Now, some people may go their whole life without getting audited, and there's people out there who have been audited 3 or 4 times. So it does happen. There might be a couple of people that get very lucky, but I dare say there'll be more people getting caught than people smiling and going to sleep at night thinking all's okay.
Right. So who are the people that are getting affected the least in this situation? So who is this not going to touch or barely touch at all?
Yeah. So if you only own investment properties in Queensland, this doesn't bother you. So there's no issues. If you only own properties in Queensland, it's business as usual. If you own a principal place of residence in your home state and own investments in Queensland, business as usual. It doesn't impact you. This only impacts people who have their own principal place of residence, which is fine, that's exempt from this calculation, but have then further investments around Australia. So investments in New South Wales, in Victoria, in WA, Northern Territory, South Australia and Tasmania, and then also properties in Queensland. So you won't be taxed, or you won't have a land tax bill if you have no property in Queensland. So don't stress. If you've got property in New South Wales and Victoria only, you're fine. And nothing in Queensland, there's no issues. It's for people that own investments in Queensland and own investments around Australia. This tax is aimed at you.
Yeah, there you go. Should we walk through an example, Joe? Or you got
Let's jump in. Let's do it.
Yeah, I like to see numbers. I'm a numbers guy.
Beautiful.
Let's look at it.
So this is one of the Excels that I've brought up. Now I'm just going to use for this particular scenario the individual rate pay threshold, because there is a threshold for trusts. But as it stands at the moment for Queensland, they haven't changed their threshold. So if you own land in Queensland between $0 to $600,000 under the old scheme, you paid no land tax. Under the old scheme, if you own between $699, you paid a $500 premium plus 1 cent for every dollar over 600,000. And you can see there how the other thresholds come into play. Now, under the new scheme, the threshold still stays. However,
so this is exactly the same. This is exactly the same as it's always been.
Thresholds don't change, rates don't change, everything remains the same. It's just now the way that they calculate the way your land is absorbed by the threshold. So under the new scheme, and I've got an example here, which I'll scroll down and show you guys. I've just created a little bit of example. So we'll just use here, we'll say Jeremy. Jeremy owns land in New South Wales of 420,000. Jeremy also has land in Victoria worth 320 and land in Queensland worth 380. So I'll just reiterate what this means. It's not the property value, it's the land value. And you can find out what your land value is by looking on a Land Tax Commissioner statement, or a good way to look at it is look at your council rate. Your council rate will have an identifiable land value. And that's how most people's council rates are calculated. But for this example here, Jeremy has 420 worth of land in New South Wales, 320 in Victoria, and 380 in Queensland. So in essence, Jeremy has $1,120,000 worth of land value around Australia. But my Queensland land value is only worth 380,000. So under the old scheme, 0 to 600,000, Jeremy was paying no land tax for his properties in Queensland. All right. So under the new scheme, because my land in Australia exceeds the $1 million threshold, which we can see here, I need to pay a premium of $4,500 plus 1.65 cents for every dollar more than 100, for any dollar more than $1 million. So in my calculation here, which you might not be able to see it, I'll just see if I can bring that up a little bit further. There we go. So if we can put our eyes up here, we've got our $4,500 premium we need to pay. Then we've got our 1.65 cents for every dollar over $1 million. It's 1.12, 1.65 cents for the $120,000. So under the new land tax scheme, the land tax applicable is $6,480. Now that's land tax on the total Australian land value. Now, what the Queensland state government said is that we're not going to tax your land tax on your total Australian property. We're only going to prorata it against the land that you have in Queensland. So the land that we have in Queensland is
this is where it becomes not a double tax. This is
where it's becoming not a double tax. Correct.
Yeah.
Correct.
Okay.
So they're only saying, well, if you had all that land in Queensland, it would be $6,480 worth of land tax. But you don't. You've only got $380,000 worth of land in Queensland. So 380 divided by our 1.12 times by our rate 2 calculation. So therefore, the land tax on my $380,000 property in Queensland is going to be $2,198. Now, in the past, it would have been zero.
Yeah. So that was going to be my next question. So right now, land in Queensland, just up the top there, is $380,000. The land tax threshold is up to $600,000. So literally, you would have paid zero land tax.
Zero land tax. Correct.
You would have just bought an investment property, $380,000, nothing to pay.
Now, why I say this is robbery, I'm just going to change a number. Now, you guys know this. We've shared this before. We came onto this live session. I'm going to say now we have 4 million. Let's say you're a very sophisticated investor. Sophisticated investor, and you've done really, really well. And you've got $4 million worth of land value in New South Wales outside your principal place of residence. Now, we'll go back to the top. Jeremy's done really well. He's got his home, but he's also got $4 million worth of land value now in New South Wales. His land value in Victoria hasn't changed because the market's gone a bit slow there. And he's only decided to buy one property in Queensland. So that's
that's what he does, right? Like he's just thinking, oh, I've got 4 mil. I probably should put some of my eggs in a different basket. So if you're not aware of this would be incredibly interesting to stumble upon when you get your next tax bill. So this is why it's very important to get educated on these types of things.
Correct. So Jeremy's thought, I'm going to go absorb a new land tax threshold because I'm sick of paying New South Wales state government more land tax. I'm going to go buy in Queensland. Now, if you remember, if we have now land between 3 to 4.99, we pay a premium of $37,500 straight off the bat, plus 1.25 cents for every dollar over 3 mil. So let's change that now. We've got total land value of 4.7 mil. Rate 2 is $37,500.
Straight off the bat, $37,000 in tax.
Our land component is 1.25%.
At least they dropped that, right?
That's it, 1.25%. And we are approximately $1.7 million over the $3 million cap. So I'll just change this to 1.7 mil. All of a sudden, We have to pay $58,000 worth of land tax again. If all of our land was in Queensland, it's not. So we get to prorata that. Now that proratament is $380,000 divided by 4.7 mil. Divided by the 4.7 mil. So then all of a sudden, that particular amount of land tax that we're needing to pay on that $380,000 property is just come up to $4,750. So significant increase on our small $380,000, which, mind you, that land did not change. That value did not change. Jeremy's just went and bought more property in New South Wales. So now if you've got property in Queensland worth $700,000 on the same 4.7, you're paying land tax of $8,750, where the threshold would have dictated that you only would have paid $1,000.
Yeah.
Right. So all of a sudden you expect a property to be cash flow positive, and it just starts to incredibly eat away at your profits.
Correct. Yeah. That's a $6,000, $7,000 increase in land tax. So it's
it's one of those. It's almost an investment sort of. You weigh up an opportunity cost and say, well, do I want to buy an extra property or do I want to buy any property in Queensland?
The problem is, Jeff, is that if it's a $6,000-7,000 increase compared to what the normal land tax would have been, on an example like that, that $7,000 could be 20%, 30% of the rent.
Yeah.
Or 10,
well,
not 10, but probably 20% of the rent.
Yeah, I don't think there would be many cases where it wouldn't make sense to go in a different state. Like if I was going to get lopped with $7,000 extra expenses onto a property, I just wouldn't invest. Like look at ACT, for instance. There's a land tax component on ACT. Investors have just entirely ruled it out. I don't buy an ACT because of that tax, because of what people have to pay.
But the argument still is in ACT, there's a substantial hike in rents there as well. Like people are getting top rents.
Yield.
There's a massive shortage for properties in the ACT, but it's governed by obviously what's going on with economic policy. Canberra is one of those places that explodes in population and decreases very quickly, depending on who's in government and how much public sector employees are required. But there are ways to get around this. There's no doubt about it. So what it does mean is that accountants need to put their hats in the basket with their clients, and they need to think hard. And what many people will do is potentially they weren't ready for a trust just yet, but a trust might ultimately be the better way to go, because a trust still gets a $350,000 land tax threshold. So in many instances, on that $380,000 or that $700,000 worth of property, the land tax might have only been $1,400, $1,500, or $500, or let's say $3,000, compared to $9,000 under the scheme. So I think if you've got lots of property around Australia and you're looking to enter into the market in Queensland, I think it makes sense for you to invest via a trust. And you've got to weigh up now that cost between the establishment and the ongoing, and the pros of a trust versus the additional land tax that we need to pay. If it was me, now take my financial incentive out of it as an accountant, I'd rather be paying $2,000 a year to maintain and do all the compliance for a trust and pay the establishment fees to get it going, than to continue to pay state government an extra $2,500 to $3,000, because the pros that come off that trust are the ability to distribute profit to your family with a vested interest in the trust and save tax, hopefully, when they've got lower marginal rates. So what it does do is it throws a spanner in the works. There are ways, obviously, to minimize it, but the problem why I said it earlier that this is robbery is that this has come on so quickly. They didn't get anybody prepared for it. A couple publications here or there 6 months ago about what they're thinking was doing. And I was one of those people saying this is never going to get passed. This is never going to get passed. This is just so stupid. It'll never get passed. And it did. And they're not grandfathering. There's no grandfather.
Yeah, that was what I was going to say is, what if I've already got a portfolio in Queensland and Victoria and New South Wales? What does that mean for me?
Yeah, no grandfathering provision in place. So it does mean that, this is a cost that you really need to take into consideration and see how it impacts you from a bottom line cash flow position.
So what happens? What are your thoughts on when investors get taxed more? What does that mean for renters, for instance? Like, does it actually impact them? Like, how does this all flow through to the end renter?
Yeah,
Because
well,
if I've got $8,000 extra to spend, it's going to have to go somewhere.
yeah, and that's the negative of it. And there are negatives of this interstate land tax coming into play. And I don't know if someone's looked at the other side of the coin when creating this legislation, but if everybody's going to get hit with this additional land tax, and I'm not going to say everybody, I'm going to say, a large portion of people with, wanting to buy 3 and 4 properties. And most people who do have 3 and 4 or 5 properties have at least 1 or 2 in Queensland, from my experience managing many clients. That cost is going to be passed on to the tenants. So with Queensland wanting to affect interstate investors and not affect the votes that they get in their elections, I think they're actually going to impact their own residents, because people will pass through this increase to their tenants. If it gets more expensive in Queensland to invest, then the rents will go up to compensate the difference. It's just how it works. Interest rates go up, that cost is passed on to the investor. And if there's no investors, there's no renters. And that's what many people have to understand. And that's why it's not a position to panic and fear, because there always needs to be renters. People can't afford to buy their home all the time. And renting is just a normal part of life. And investors provide that as a service. Yes, there's a benefit on top with the capital growth, but it still is a service that a landlord does provide, which is their home they're paying a mortgage on, or a home that they've worked very hard to buy.
So what can we do Like, what can I do right now, today, or over the next couple of weeks to be able to prepare myself as an investor for this and get this kind of wrapped up?
Well, the good thing is that this information is not just available to professionals. That's solicitors, accountants, and property consultants. This information is available to the public. And, I just went onto Google and typed in interstate property Queensland land tax, and it was the first link that came up. I'm sure you guys will post something for everyone. And I know that you have, Joe, posted, and Jeff's posted already for people to read. But you can do your own calculations. It's not hard. It's not a difficult calculation. They do provide some examples there of a lovely lady, Lena, who, good on you, Lena, for putting yourself in there. But, her example's on there to show how she's calculated the land tax based upon her Queensland and her Australian-based property. So you can actually get a fundamental view of what this land tax does to your overall position. You can find your land values, as I mentioned, on your council certificates. And it's a cost you need to review. And it's also something that you need to maybe chat with your professional about for future investing, if you are going to be buying in Queensland moving forward, with the aim of having a larger Australian property-based portfolio.
Yeah, the way I look at it is, well, how much extra is it going to cost me from a tax perspective, and then sort of weigh up and look at how much. And even speaking, I'd say speak to your property managers in the area and understand, well, what sort of leeway is it actually increase your rent. I mean, as much as I don't want to encourage landlords to become slumlords, I think at the same time, if this is the path that the Queensland government or any government wants to take, how you need to sort of look out for your to some degree your own bottom line, and sort of say, well, what measures can I take to future-proof my investment and my family's future as well. I think that's what I'd do.
Yep, and there are exclusions. There's no doubt about it. They've gone in there and said, what are the exclusions for interstate land? Your principal place of residence is an exclusion. Properties which are used for primary production, supported accommodation, retirement villages, charitable organisations, aged cares, exemptions for Queensland land, societies, clubs, port authorities, and governments. So they have made some exceptions, but pretty consistent with how state governments around Australia do it anyways. But yeah, just to reiterate, I suppose the main things is that it's not a double taxation. It's just taking into account your Australian-based land holdings, prorating it based upon your Queensland land holdings. If you've got no Queensland property, it doesn't impact you. If you've only got Queensland property, then you're not impacted. It's just for the people that have investments, around Australia. And this is a calculation which may impact you. And there are things and tools available to help you minimize it, such as, establishing new entities and buying property in Queensland if that's the state you feel comfortable investing in. But it's not fun, this one.
Yeah, if you don't own property in Queensland, the best advice would be to speak with your accountant, because if you don't yet own property in Queensland, if you already own property in Queensland, this is what you now have to deal with. But if you're yet to own and you're looking to, and you're considering Queensland as your option, you've got to think about that, and then maybe, speak with your qualified accountant to see if that trust is for you. Any other things that we should cover off on this one, Jeremy?
No, they're probably the main things. We need to, as I said, it is self-declared, no doubt about it. But as I said, it's not a voluntary, I put my hand up and I'm happy to pay it. This is something that, the Queensland state government see this as a major revenue earner for them, significant enough that they'll put together a task force which will review all these things, because there's a substantial amount of value there they're going to obtain. And there'll be more forms that come out where professionals will need to substantiate this, potentially on the sale of a Queensland property. So it's nasty. That's why I'm passionate to say that it is a little bit of a robbery compared to many other states. And Queensland's been a very giving state to investors for many years. But as I said, these are all hurdles, and I've seen many hurdles and changes. Everyone thought the world was going to collapse when depreciation changed the way that the calculation was done for existing properties. And we kind of picked ourselves up, moved on, and found other ways to gain benefit. This is just one of those hurdles that we'll overcome. There's structures out there which will help overcome it. But I think it's just now knowing the new numbers to work out new net yields and then factoring that into your new purchases. I still tip Queensland to be the better performer across all of the Australian states. And I think it's been a sleepy giant for a long time. And definitely it's seen the lion's share of population, that's for sure. Yeah.
We really appreciate you being a constant voice of somebody who can give information on tax and just investing in general as well. So I appreciate you jumping on this session with us, and we'll get it out, get the word out there to the Australian property investor or Oz property investor community. And
beautiful.
Absolutely.
Thanks very
Jeremey
much,
from KHI Partners. Thank you very much. See you later.
Well, Joe, for setting this up.